Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. This week we want to review over the just released fourth quarter GDP results and talk about some headwinds that we see for 2019. Overall, as you know, the GDP for the fourth quarter came in at below where we were in the third quarter at 2.6%. So we've seen a pull off from where we were, but when we look back in history, we're still doing rather well. In fact, when we look at the whole year for 2018, we're at about a 2.9% GDP, still higher than where we were in 2016 and 17. However, we do see this downward trend over the past 3 quarters. When we look at the individual components of the GDP, we can see that the consumer segment contributed 1.92 percentage points into the overall growth rate. Investments contributed 82 basis points when we look at that contribution. Overall, we continue to see the non-residential investments increasing, while we see over the past several quarters that residential portion continuing to pull off. We did have a positive change in those inventories, but not to the extent that we saw back in the third quarter. So we saw that overall contribution drop down from that 253 basis points in the third quarter down to the 82 basis points in the fourth quarter. And that's primarily to the reduction of those inventories. But overall, in the government, contributing just 7 basis points here for the fourth quarter, and the net of the exports imports detracting 22 basis points, better than where we were in the third quarter when we had almost a 200 basis point pull off from the net exports. So overall, we've seen a downward trend, slowing in that growth in almost all categories, especially in that consumer segment. Overall, when we look at the inflation expectations and inflation in general, we can see that the PCE came in at that 1.5%, well below the 2% level that the Fed is targeting. And then we drop down and we look at the core PCE, taking out that food and energy, and that number came in at a 1.8. So overall, inflation continues to be moderated in here. And all these, we factor everything in, and what we've seen over the past several months in terms of the news and the economy. The global slowdown is one of the headwinds that we see in 2019, and we'll look at a couple more charts in a minute to go into that a little bit, but the global slowdown is going to be a concern. Overall, feeding into that somewhat are the trade wars that we see going on, and we know that the United States and China, we seem to have come to some sort of agreement right now, still nothing signed, so we'll see how that kind of shakes out, but that overall enters in to the market some unknowns, and that unknown typically generates some volatility. So we have that to deal with for 2019. When we look at the Brexit, that's unresolved. We still don't know how that's going to shake out, so that feeds into that overall slowdown in the global growth. The debt ceiling issue is creeping up here. In fact, on the 1st, which is tomorrow, March 1st, we reach that debt ceiling expiring in terms of the suspension. So the question is, what will Congress do? Will they push it out again, or will they raise it? Most likely they're not going to raise it at this point, but they do have some, the Treasury does have some ways to take money from different areas, just accounting entries, to provide some funding for their expenses throughout the remainder of the spring and most likely into the summer, maybe early fall. So it's anywhere between end of July and October is when they would run out of that cash if they don't do anything. So we're going to see that. That's going to be in the news, and we'll talk a little bit more about that as time goes by. The quantitative tightening here, so the Fed reducing down their balance sheet, we've seen this going on. We're at that tune of $50 billion a month now, $600 billion a year, but we've seen the Fed come out and suggest that they have plans to maybe stop that this year, and how will that overall impact the rates. But overall, when we look at that quantitative tightening, that's going to be about a 1% raise in rates in terms of what it reflects in the market. So while the Fed now is patient in terms of Fed funds rate, that quantitative tightening is another measure of a rate hike per se. And then, like I said, that patient talk, and we'll talk a little bit about that. But when we look at the global slowdown, it should not be a surprise, because we've seen the charts, this chart here, the projection from the Fed. This was back in December. We'll get a new set this month, in March. And then you can see overall 2019 at a 2.3%, 2020 at a 2%, 2021 at a 1.8% GDP growth. So we see this slowdown in the GDP for the United States. But not only that, when we look at the IMF shows the similar numbers and the same trend for the United States, going down to 2.5% in 2019 and 1.8% in 2020. So that continued slowdown, but it's not only the United States. We see that for the Euro area and, in fact, all the advanced economies, as well as the world output. And when we take that into consideration, to think the United States is the largest economy at $20 trillion. China is second at $13 trillion. And then we have Japan and Germany. So the first four items here, these economies are all showing a slowdown, not necessarily a reduction in GDP for the US or China, but a slowdown from the prior year. When we get into Japan, they have seen a negative GDP growth over time, and Germany in the fourth quarter saw negative GDP growth. So this global slowdown is going to be a definite headwind. And then we have the United Kingdom at number 5 in terms of the rank at 2.8 trillion. And the question is how is Brexit going to impact their GDP for 2019? When we look at the overall QT tightening, so we look, the United States has pulled off, but we're not the only ones. We look and you see the assets of the major central banks throughout 2018 has declined in here. The majority of that would be the United States reduction, but you can see how much it's grown from where we were back in 2008, from just north of $6 trillion globally, all the way up to a little over $21 trillion in 2018. That patient talk from the Fed, this kind of made the market kind of flip over in terms of the probabilities of Fed funds. If we were looking at this back in December, we would have had 2 Fed funds hikes as a probability, and now this is as of the 25th. You can see here we have a 23.7% probability of a rate cut in January of 2020. So totally different outlook in terms of Fed funds. This is important because these are the mechanism of short-term rates. showing that they potentially could come down over the next year. Now, that being said, and we've said this before, even though the Fed funds we anticipate not changing throughout the year, deposit costs are going to continue to go up, and that cost of funds will continue to increase throughout 2019, pulling off from that overall net interest margin for institutions. So it's going to be, if I could add that as maybe not an economic headwind, but for the banking environment, the headwind of continued cost of funds increasing and lowering that net interest margin. That's what we have for you today. We look forward to talking to you in the near future. Have a great day, everyone.